Chad, let's start with this. It's just dropped in my inbox. Comes from Bank of America again, and they say the following. The latest worry is rising bond yields and inflation. Interestingly, we have gone from all that skepticism about no V-shaped recovery straight to the opposite end, inflation, all within a few months. Worriers are going to worry. Are you worried, Chad?
Well, we're not worried, but the markets in general are at a high end in regard to valuation. So when you have an earnings yield of roughly about 4.5%, and you have a 10-year bond that's starting to creep much higher and could potentially go from 175 to 250, bonds then become much more of a competitive asset class. But the Federal Reserve is going to wait. Obviously, they want to wait until COVID is in the rearview mirror, and they won't move unless there's financial stress. So overall, we would be balanced, we'd be in high-quality names, but nonetheless, we would not be worried.
Pete, do you want to stick with that cyclical trade as well? Just build on what you said earlier.
I do, and I also want to look for what's going to be the future of ESG. I think one reason I think inflation is going to be much higher than a lot of other people think is they're not thinking about how ESG could impact inflation. I think what you're going to see is, for example, right, if ESG production was already the cheapest, companies would be doing it. They're going to start producing. They're going to change how they produce. That's going to increase the cost. I think consumers are willing to pay more for ESG-friendly goods. I think stock investors actually will pay more for ESG-friendly companies. So you're going to see that shift. That's going to be inflationary. And that's also where I see some opportunities. I really do think ESG investing is going to be less about a snapshot of where we are today and more of which companies do we want to back and where do we think they'll be in 5 years, 10 years. And that opens up a lot of different opportunities to be an ESG investor in some big traditional companies. So I really like that sector. I think that's where we're going to see a very big pop in the coming months.
Pete, I love that you took my question, ignored it, and just threw in your talking points. So let's talk about it a little bit more. Pete, what do you think is underappreciated about that? Because I hear about it every day, every morning, all day, every week, and so does everyone else.
So I think ESG investing is here, it's growing, but it's going to become more and more sophisticated. And when I look at some of the big companies that were left behind, either their industry wasn't deemed ESG friendly or maybe their product mix wasn't deemed ESG friendly, you've seen these incredible evaluations on some new tech. I think people are going to come back and say, you know what, I actually trust this management. I trust their ability to perform. They now get the joke. Their board of directors are on board. They are going to be an ESG company in 3, 5, 10 years. I want to back them because I get a much better valuation and probably a better shot at good execution over time.
So, Chad, this is about themes beyond just a cyclical recovery. Are you on board with them?
Not really. Our viewpoint is that you have to be careful, in particular on certain slices of the market that have had this euphoric run. And many companies have been selling that note, and in regard, they're getting a premium valuation. So we're on board with value. We're on board more with quality companies. We think that the overall financial system is underpricing risk, and I want to be very clear about that. So we think that one should be in the highest quality names. In regard to the cyclical rebound, you can look at Raytheon Technologies, you can look at General Dynamics or Honeywell. In regard to healthcare, they've been absolutely left in the dust. You can look at Pfizer, Merck, and Becton Dickinson. We think that you should take a 24 to 36-month viewpoint on this, but we do believe value is the place to be right now.
Well, let's just sit on that point just for a moment. We started this week by having a big conversation about whether growth expectations were peaking. Not realised growth, because we haven't seen the numbers yet, but expectations. And when is that moment to move away from the cyclicals and just look at a return to trend growth again and maybe get back on board with those secular growth stories? Pete, as you look for the signposts in the road, so to speak, and I don't expect you to get a crystal ball, I just want to understand your reaction function, your personal biases and how you behave to data as it comes in. What are you looking for in the road ahead that would make you say, you know what, expectations have peaked, it's time to move away from this big cyclical trade, this reopening, this recovery, in the same way that Morgan Stanley has come on this program more recently and talked about that with a little bit more nuance?
You know, unfortunately, I'm back to looking at DC for that. I need to see real infrastructure spending, real fiscal stimulus that's going to be job creating. I'm a little bit worried that some bridges were burned getting this past stimulus deal done, and we're not going to get as much good infrastructure and future stimulus as I was hoping. And it really has to be job creating, right? That's what I'm looking for. That's still my base case. I am a little bit nervous about that. And at the other side of things, I'm a little bit concerned that we're going to see real efforts to kind of, tax companies away, and that would be concerning for me. So right now, I think we survived through that, but that's where my eyes are focused, is on DC and how this next wave of stimulus plays out.
The reason I raise this, and I don't think anyone who is a forecaster, I don't think we can sit here and say the forecast is gospel. By definition, it's a forecast. But if you look at the numbers out of the Fed, Chad, and this is what they're telling us, 6.5% GDP growth up front this year, then back to 2.2 in 2023. And I guess the simple way of trying to express what I'm thinking about at the moment is, when do we stop thinking about the 6.5 and start thinking about the 2.2 again? When does that kick in, Chad?
So I think that kicks in perhaps by the beginning of the summer months. We are off consensus. Our long run expectation for U.S. GDP growth is roughly about 2.4%. I believe the Federal Reserve is about a 1.8% number. Our expectation is, the reasoning behind that is that we think productivity as well as labor force growth could be quite robust over the course of the next 10 years. That to us is meaningful because that means that the curve will start to normalize regardless of what occurs over the course of the next 6 months.
You would assume when we start thinking about the latter number, the smaller number, we start thinking about this NASDAQ looking good again. Right now it's down by 1.3%, the S&P off by 0.5%. Pete, I'll give you the final word. The final word, please.
I agree with Chad. I think we are going to see better than forecast growth. I think 2.4% might even be low for 2023, and that's going to depend on the stimulus. But I think people are going to start baking in real exceptional growth, and that's going to be important to drive markets further.